Hey, everybody. Welcome to another episode of the System2 podcast. Today, I'm talking to Ari Levy, who is the Chief Investment Officer of Lakeview Investment Group. Welcome to the show, Ari.
Thanks, Matei. Thanks for having me.
Awesome. Well, why don't we learn a little bit more about you? What's your story?
Sure. So I'm 46, born and raised in Chicago in Lincoln Park in the city. Went to kindergarten through 12th at a school called Francis Parker School, private school in the city. College, 4 years at Stanford, outside of a couple quarters. One in Italy, one in Israel. I was in Palo Alto at Stanford and majored in international relations. But always sort of from a very young age, math was my number one passion. But I've always had a artsier, creative side, or at least I think so. Try to cultivate that as well and try to have more balance. But my number one passion is math, and from a young age, I was simulating baseball seasons and thinking about probability theory, whether it be the odds of a deck of cards or dice or whatever, and that extended into college. I took a freshman seminar at Stanford called Math and Sports. That was my favorite class ever. It's kind of combining different passions of mine. It was a great experience. Had a professor named Tom Cover, who was a mentor of sorts for me. In that class, we formed a card counting team, a blackjack, and went to Vegas, more Reno, Tahoe regularly, once a month or every couple months, and sometimes Vegas. And not allowed to play blackjack anywhere in the Strip in Las Vegas anymore. But that's sort of just some of the base of my math passion that found bigger fish to fry in the public markets, but using some of those same skills and passions. And in college, also had a sports gambling arbitrage system that my roommate and I came up with, which has some applicability to what I do in the markets I can get into in a bit. But anyway, post college, went to work in investment banking at a firm called Mezro Financial in Chicago. It was a middle market, mostly sell-side engagement shop, and realized over the course of a year and change that I was there, while I learned a tremendous amount, burned the midnight oil in the typical analyst investment banking world. I realized that I wanted to be on the buy side rather than being an intermediary of sorts. I wanted to be the one making the buying and selling decisions. Went to work for a firm in Chicago called Advisory Research in 2002. Was there through until late 2004. Worked my way up to being a portfolio manager of a microcap value fund there. I was all public market investing. Their firm philosophy was very deep value, focused on companies often trading at discounts to book value or net asset value if book value didn't accurately appraise assets. Sort of an old school value shop. A mentor there named David Heller, who was taught me a ton. Very wise old value investor. Studied tons of history of the markets, did anomalies market research, and left in late 2004 to start my own company, which is Lakeview Investment Group. We've been around for now 20 years plus. We've had sort of different iterations of what we do. The first 8 years, we had outside capital in what was predominantly small cap value, micro through mid cap, small cap value, fundamental investing. Our first 8 years, we had outside capital predominantly focused on micro through mid cap investing, active but not activist. We do more activist campaigns now. I'll talk about that later. We compounded at 11.7% net over that time. Nicely outperforming the S&P 500 and all the various indices. I think our peak was about 130 million in assets. But I've never really liked marketing. I like the research and the trading. Frankly, over that time, developed some. Toward the end of that time, I developed some higher frequency, more math-based strategies. One of them was in the volatility future space, and that captured a ton of my attention. Wasn't sort of the mandate that people signed up for, and decided to return capital in 2013 on a high note, to focus on both this arbitrage trading, which was capacity constrained, and just to use my own capital. And I have a partner named Tim as well, and so his capital as well. He's been with me for 20 years. Uh, and also to focus on a special purpose acquisition vehicle that I was the president of. So in 2013, we raised $150 million. Citigroup was our investment banker in a special purpose acquisition vehicle. And this is well before the SPAC craze that came on later, thankfully. And we ended up merging our SPAC, which was called Levy Acquisition Corp, with a West Coast taco chain called Del Taco. If you're not familiar, it's the distant second, but the second largest Mexican quick service chain in the country. Distant second to Taco Bell is the big behemoth. Del Taco is regional in that it's predominantly in Southern California and the West Coast, Vegas, Denver, Portland, cities on the West Coast. And so people east of the Mississippi often haven't heard of it, but it's in LA, Riverside, and Orange County. It's similar market share to Taco Bell. And so we felt it was a good public company at the time. And very, very interesting experience. SPACs have capital that's held in trust, but it has a put right. We were out there competing against private equity firms, large private equity firms for different assets, and they could just call cash from their funds. Fund 4, that was $1 billion or whatever, depending on which fund. And we had to say, well, we have got 150 million, but it's in trust. Let's got to do this roadshow and convince all the capital to stay in. At the time, Del Taco was owned by Goldman Sachs, and we convinced Goldman to merge with our public company. And so they said, well, we need some guaranteed capital. This was a couple weekends before Christmas in, I think, 2014, and we worked really hard and came up with it. Put in a fair amount myself, more on top of the SPAC, and then raised a bunch of outside capital. I think we raised 155 million of committed capital. That satisfied them, and then we merged all the stock traded up. We priced it well. All of the 150 million actually stayed in the company, and then we were off to the races as a public company. So I'd always, from being a small cap investor, wanted to sort of help craft the pitch from the other side of the table. I had never been on a public board, and sat across the table from so many different public companies and management teams telling their story. And this, I should say also, I grew up, my family is in the restaurant business. And so I had a lot of knowledge about it. I partnered with my father on that. He was the chairman and he became the chairman of Del Taco. So that was a super fun experience for me to work with my father on that. It was a great intersection of our different skills. He's more of a creative, he's a restaurateur, foodie, marketing type person. I'm more of a quant, so I think it was a good marriage of our skills. And my brother as well is the chief acquisition officer, and then our whole team. Tim was involved. My team at Lakeview. Anyway, that we merged in 2015, and so throughout that decade, 10 to 2020, it was closing the old version of Lakeview, doing the SPAC, and trading a lot of volatility futures, in addition to continuing to invest in different stocks and other trading strategies. But it was just after 2013, just our own capital, until late 23 when we raised some outside capital. Again, I can get to that. During that decade was, had a lot of different things going on, a lot of balls in the air. In 2014, with some friends from high school, medical cannabis went legal in Illinois, and we founded what is now, I believe, the largest cannabis company in the country, called Green Thumb Industries. I was on the board until 2017. Guy I grew up with by the name of Ben Kohler is the CEO of that. It trades publicly in Canada and also in the U.S. And we won the most licenses in Illinois. Ben has done a fantastic job and gone on to, like I said, be the largest player in the country and have licenses all over the country, mostly limited license states. Was it's been a great business, great investment. I am much more of a value investor than a venture investor, but that was a really exciting venture, and it took a lot of risk. Certain people have a stigma around it, and banks have had their questions, but it's it was the right risk to take, and it's paid off and made 80 times my money, which was great, and did it with friends, and so that was a formative experience as well. And then in 2015, I believe it was, probably the only thing I'm ever in the news for is I acquired with Tim and some other friends of a famous hot dog stand in Chicago called the Wiener Circle. And it is basically a shack. It was a pretty decrepit shack when we bought it. We fixed it up a lot, put a back deck on and event space. But it's been there since 1983. It's 2 blocks from where I grew up, 2 blocks from where I live now, and is known for not only great Chicago charred hot dogs from Vienna Beef, which is the best hot dog company out there, and it's also known for roast comedy. And so it's sort of half comedy club, half restaurant, and it's particularly busy late at night when the kids go leave the bars, and it does significant volume. It's hard to make money selling hot dogs. You got to sell a lot of hot dogs, but we've made it work in all kinds of different fun promotions. It, hasn't always paid in a financial return. It's paid in laughter, which as I've found to put a premium on. I really love comedy. I love roast comedy. Met tons of interesting people through it, famous people, other people, traveling comedians, musicians. We feed touring musicians for free. I'm a big music person. I play piano and I love music. So it's been a really fun experience to kind of get involved in what I consider a performance art asset. It's been on all the talk shows, and we've had Thursday Night Football comes every year with Amazon. Monday Night Football, you name it, people have probably been there. Certainly, it's a big tourist spot, but it's kind of a voice of the community, and we've had a ton of fun with it. We've made the marquee sign somewhat famous for pointed, often if we're good at it, witty commentary. It's 15 characters by 4 lines, so it appeals more to the creative part of my brain. But that's been a really fun thing. I can tell you more about that too. I realize this is long winded. My ADD has me doing all sorts of different things, and I'm a passionate person. I love what I do, and I'd like to sort of flex the left brain and the right brain.
Yeah, tell me more about that. I mean, you mentioned that as a kid you were very much into math, but your dad, it sounds like, yeah, he was a restaurateur, foodie, much more creative. Where do you feel like you got your quant side from? And now, what was that like growing up in a household where I guess at least your dad was much more creative?
I think my mom was more quantitative, actually. She had a retail business called Material Possessions that she doesn't own anymore, but that she was balancing the checkbooks by hand with the pen, very detail oriented. My dad's no slouch at math himself, but takes more of a marketing approach, really good people, networking. I learned a lot at the dinner table from both of them and through osmosis, but I don't know. I don't know where that passion came from exactly. And no one else in my family is like as passionate about math, and it's really probability theory that I love the most.
Hey, yeah, what age did you realize you like probability? You mentioned getting into sports relatively early on, but I feel like most kids don't know what probability is. It's not even taught in most high schools. At what point did you realize that that was what appealed to you?
So the old Apple IIe computer in 1984, 85. I was born in 79. I have 3 older brothers. They're between 9 and 14 years older than me. So I got turned on to video games early. In television was big in our house. It was the other one from Atari. And so I liked thinking. I just, from early days, video games and Apple IIe video games and in television, I really just thought of strategy, and I was trying to compete with, when I was 6, with my 15-year-old brother and my 18-year-old brother, and I had to try to keep up. And there was a game on Apple IIe. I don't even remember what it was called. It was like such a primitive video game where a lot of famous World Series teams, like you could be the 27 Yankees and play against the 55 Giants and have, Babe Ruth against Mickey Mantle. And you wouldn't even click a button to hit. You would hit enter, and you would either hit SB for stolen base if you're trying to steal a base, or HR for hit and run. And then you did enter. I would simulate baseball seasons and see how the 55 Dodgers and Giants did against the 27 Yankees, the 1980 Phillies. So just some of the 78 Dodgers, and, just thought about how to win in that game, or in simulating, just thinking about batting averages, on base percentage, things like that, and
Did the game
just followed my passion there.
did the game display any of these stats, the batting averages, et cetera, so you can make some of these decisions, or how did you
So
yeah.
yeah, so the seasons, or the statistics from that season, and I assume the underlying code was along those percentages, and Babe Ruth was much more likely to hit a home run than someone else. But yeah, so I mean, I looked at the averages and the percentages and the ERAs and all that stuff, and um,
That's such an
as
interesting, yeah, because they don't make games like that anymore, obviously, right? And
yeah,
it forced you to, because it wasn't so much about your skill on the controller, how quickly you push buttons. It was much more about how do you actually the strategy behind it, like what's the right move in the context of these two teams. And it's yeah, I think it's a fascinating way to force kids to think more about the probabilities and to be like, oh no, this was all like me because I was really fast on the trigger or whatever.
totally. I mean, I think it's a lost art. I have a 9 and 10 year old daughters, and they want to play Roblox all the time, and it's hard. I'd like to get them, let's play Monopoly or some of the old school games, and think about that kind of stuff. They're much more creative than I am, but it's hard. It was a different era where you'd to make an extra 10 minutes. I'd either go to the piano or go to the video games, and to hear their that's not always the most educational stuff now. So it's a hard thing to balance as a parent.
Yeah. And you mentioned that that was the math and sports was your favorite class that you've taken. I'm curious how you think about education, especially with math or statistics, where it is often not seen as something that kids want to do. And I wonder how much of that is if it's taught too theoretically versus if it's taught in an applied context, like with sports, that can resonate much more with kids. I mean, how you have kids yourself? How do you think about teaching them or at least giving them some exposure to the probability and making it more fun and interesting?
Yeah, I mean, to use real life examples, and yeah, games of strategy. If you were to make this move, what's the other team going to do? And think 2-3 steps ahead on the board, which is important. So play chess with my daughter and try to get her to think about that. But it's hard. You got to find something that they're passionate about with statistics. And my girls are, like I said, more artsy and creative. So it's hard to be like, okay, this baseball team is playing this baseball team. Like they could care less. Got my daughter into a fantasy football league, which she won last year. I tried not to help her too much, but I definitely had to help her some because she doesn't really know what a quarterback is or a kicker is. And she beat the other fourth graders in her league. And by the way, the losing four teams had to work a shift at the Wiener Circle, so we had a bunch of 10-year-old free labor learning some language they probably shouldn't have. You
I
know,
love it.
the thing. But it's an interesting question. Yeah, I think you're right. More real world applicability, things that they're fun, not just theoretical. My daughters are getting into fractions and division and multiplication now, but to have real world examples certainly helps. But you got to find things that they're passionate about.
Yeah. Well, I want to get back to the story around blackjack and why you're no longer allowed to play in Vegas. What were some of the stories that came out of that? I'm sure there's yeah, those are not the types of people that you want to piss off. And given that you guys, it sounds like you were doing quite well to be banned like that. What happened there?
It's actually not as much of a how you perform as if you're counting. So everyone thinks the movie Rain Man, I don't know if you've seen it, but
Yeah.
he knows every card that's going to come out, and that's not what card counting is, and it was actually somewhat unrealistic. It's taking the small edge that the casino has if you're playing basic strategy, and taking that edge and making it your small edge. But it's really a long run game. If we were to go to a casino now and play for 1 hour, and you were just playing basic strategy or just like an average player, and I was counting cards, my chances of winning would be only very slightly higher than yours. And it's really a long run statistics thing. So if you think about, if you had a weighted coin that was 51-49 one way, 51 it's a little bit heavier weighted that way. That's the casino's edge, let's say, in blackjack on average. I'm rounding, maybe it's 52-48, but it depends on the rules. Are you allowed? It really comes down to every little detail. Are you allowed to resplit aces? Can you double down on anything? Each of those rule changes comes with it its own, you know, expected value. So at the time in college, there were some places. There was a place in South Lake Tahoe called the Lakeside Inn that had the most liberal blackjack rules in the world, actually, to the point that if you did play basic strategy, you would have an edge on the casino. But it's not. It's not what people think it is, in that it's like a guaranteed victory. I've had plenty of swings, and like I said, I can't play anymore. It's like it's a long run game, and found bigger fish to fry in the public markets. So yeah, we would pool capital together in college from our dorm mates. Frankly, we had some success doing it, but we didn't make money every trip, because in the short run you go on one trip, and as your team plays 20 or 30 or whatever is collective hours, you still have, let's say, only a 62% chance of winning that. I don't have all the math in front of me, but it's like it gets higher the longer you play. You gotta have more statistical trials. And so over time, if you card counting, an important principle is that coin, that 5149 coin that's weighted toward the casino off the top of the deck, changes as the cards come out. Assuming there's not an automatic shuffler, if a bunch of low cards come out, that means there's a much higher preponderance of high cards left in the deck, or vice versa. And if there's a bunch of high cards left in the deck, it's to the player's advantage. If there's a bunch of low cards left in the deck, relatively weighted, then it's to the casino's advantage. And the best way I could sort of simplify it and explain it is, if you think about a deck, let's say all the low cards came out. You're just playing with a single deck. They don't really have those anymore. Lakeside Inn did, but you don't have those anymore. If it was only aces and tens left in the deck, and blackjack paid 3-2, which it used to everywhere, and now it doesn't. Surprised they pay 6-5 in a lot of places. I would only play at a 3-2 table. If you get blackjack, because there's aces and tens, you get paid 3-2. If the house gets blackjack, you only have to lose 1-1. And so a lot of it is there in our system. You keep a side count of aces, and there's a bunch of aces left. And by the way, this was all legal. They have the right to deny you service, but and they did, but it's they're creating the rules. You're sitting down using your brain. There's no like device or anything. It's just a student of the game, and have an edge on them, and they have the right to tell you can't play anymore. And so it's just really, it's good foundation math. There's a really important math principle in card counting, that works for card counting, called the Kelly criterion. And what that is it tells you basically how much risk to take on any one wager. In this case, it's a blackjack hand, given a known set of probabilities. So, there's 52 cards in a deck, there's 4 suits, there's 4 of each card, etc. And so for that, the count, if the count gets so high, it could be as much as 58-42, maybe slightly higher, into the player's advantage. And so if you were told you could play a game where you could flip a coin that was 58% heads, 42% tails, you would obviously take heads every time. But what the Kelly criterion does is it tells you how much to risk on that or really any wager, such that you are maximizing your profit without putting a risk of it's called the risk of ruin. But the ruin doesn't mean losing all your money, putting a big enough hole in your balance sheet that you're not going to be able to make it back, or it's going to be inefficient. So in card counting, when the count gets as good as it does, you want to bet no more than 2% of your total bankroll. And so that's an important lesson. In the public markets, securities technically are more of a random walk. History doesn't repeat itself exactly the same way, but it rhymes. And it is, there's more theoretical things, as you have to sort of take an instinctual decision of, well, it's not a known, exact probability set of cards. I've seen this movie before. I've made this trade before. I've owned this stock before. And we're just looking for inefficiently priced securities through either a fundamental lens, meaning, this company is cheap or expensive. In the case of a short, although we tend to be more long biased. We do plenty of shorting too, but it's because of the multiples it trades for, downside, upside. And so if you can know in your head that you think a security has great downside protection. Maybe it's, not going to compound at the best return, highest flying growth return. But if you were told you've got a ton of downside protection from asset value, could be a, business that's not in the real estate business, but that happens to own a ton of real estate. That's gap, gap accounting holds land at cost. Well, for example, and I realize I'm away from the blackjack question, but I'm trying to get into the real world of thinking about downside upside with a security, and if it's a stock, as an example, while we don't own any of these stocks now, there's 3 or 4 tickers of public companies that own significant amounts of real estate in the islands of Hawaii. And a lot of it, these companies are, 100 plus years old. Land is held on the books at cost. So there are companies based in Hawaii that when they sell their land, they have a 99+% gross margin because they bought it for $1 an acre, $100 an acre, whatever it was a gazillion years ago. And now that asset is not accurately reflected on their balance sheet. So we look for hidden assets, and we like companies that trade below their net asset value. It gives you a much higher margin of safety where theoretically, if you're buying a company where the market value of the equity is less than the net asset value equity or book value equity, if it accurately depicts assets net asset value, theoretically, that gives you downside protection where a company could sell all of its assets, pay back its liabilities, and now you get your money back. And then the upside is, what are they going to do with that capital? Are they going to get a good return? Are they going to earn more than their cost of capital? That's kind of an old school value way of investing in things, and kind of my old mentor, David, a strategy that he imparted to me very well. But then there's also, the newer school value. Growth has outperformed value quite a bit for I want to say decade and a half. You want to make companies to make a good return on investment, because if a company is trading at book value but they don't make any money, that's not great. So you want, book value will decline, grows or declines by net income generally. And so if it's losing money, book value will decline, and they're not only are they not earning their cost of capital, they're not earning anything. So there's a blackjack and Kelly criterion and sports and a lot of stuff sort of help the foundation for more of the fundamental side of what we do, which is trying to find inefficiently priced securities that are cheap or expensive based on both quantitative metrics, fundamental quantitative metrics, but also, we get to know the management teams. Do they have a competitive advantage? Who are their competitors? What's their differentiated competitive position, et cetera? And that's just one lens. And then I've been allocating much more toward arbitrage lately and less toward fundamental value. The markets run quite a bit, harder to value things right now. There's a lot of uncertainty in the world. I think the only thing that's certain is that we're going to have volatility. And so we've pivoted some to higher turnover, arbitrage-like type strategies, basis trades. Actually not that dissimilar from some of the sports gambling stuff I did in college, where we knew the probabilities. So like in the sports world, let's say the Bears are playing the Vikings, and at one site, the Bears are favored by 3, and at a different place, the Bears are favored by 3.5. Well, you could wager on the Bears -3 and then take the Vikings +3.5. It's the same game. If the Bears were to win by exactly 3, which when I was in college, there was a 14% chance of probability that would occur if the spread was that, you would win one side and tie on the other. Or if you got 2.5 and 3.5, you would win on both sides. And so what we're trying to do is find middles of the same games. That means ETFs. There's two different versions or more of the same thing, or essentially the same thing. And we don't care what that is, as long as it's regulated and liquid enough that we can trade it. Like we've traded a lot of crypto lately, not because we are necessarily huge believers in crypto, but because there is regulated, liquid ways to trade it, where you can trade 2 different versions of Bitcoin or Ether against each other, Ethereum. And those could be a future against an ETF against an ETF. And you call a basis trade, where you're buying and selling different versions of the same thing, buying at a cheaper price than you're selling the other security. And based on, a lot of historical analysis, you're playing and tools to execute at these prices, we're betting on meaner versions. So, that the thing, that the spread between the thing we buy and sell, or the multiple securities, is going to converge, and use technology to, to get the best execution and buy and sell concurrently at the same time, different versions of the same thing.
Do you guys put leverage on that? 'Cause sometimes like the delta between the two sides is rather
Small.
small, right? So if you want to make some money, you got to lever it up.
We will, particularly when it's exactly the same thing, but we're mindful of risk. We don't go bigger than 20% on any particular ETF or, or position rather. On individual investments, our exposures are typically lower than that, but we will concentrate, and this is more on the fundamental side. We'll go up to 20%, but that's been rare. Typically, it's more up to 10, and that's when we have a super inefficiently priced security. But yes, to your question, we can at times. Right now, we have a little bit. We're probably, I'd say we're about 200% gross leverage. Yeah, full. Yeah, but 100 long, 100 short. So from that standpoint, but we are, for borrowing right now, it's a very, very small amount. But yes, theoretically, to optimize that, to your point, because sometimes those spreads are small, you take leverage. Now, when those spreads come in and there's not tons of interesting things to do, you take down the leverage. But barring some totally unexpected crazy thing that might have that asset not traded at NAV, or if there was fraud or something like that, which is why you don't bet the house on any one thing. Um, those spreads work time and time again, and it's a much better sleep at night type thing where you're buying and selling different versions of the same thing versus some company that you might wake up and might make a dumb acquisition and their stock craters, and there's alignment. There's poor alignment sometimes between the shareholders and the board, frankly, and management. Yeah, so our fund is a combination of our best fundamental ideas and our best arb ideas, but really good questions about the hard stuff.
How do you think about? So you mentioned the Kelly criterion, where it tells you how much to wager on any hand of blackjack. And there's a similar analog in portfolio management, right? Because it's not just about picking companies of long or a short, but it's also about a position sizing. How much you have a bunch of other stuff in your portfolio. As you mentioned, you have some limits on how big the largest positions can be. But how do you think about knowing what you know about each of your investments, how to size them appropriately in the context of the broader portfolio?
So it's less. It's there's more theoretical, instinctual parts of it than if it's a known set of odds, like you're rolling dice or a deck of cards. But from doing it for a long time, you get a much better sense of, hey, what's the downside upside of this thing? What would happen even if I thought that there's a lot of downside protection, there was fraud, and this company actually, even though they were compliant with the SEC one day and they own all this stuff, they were lying. We've all seen frauds before. And what would be the worst case scenario? When I used to trade a lot more volatility futures, think what would happen if a huge terrorist event happened? Early in my career, I was working when September 11th happened. I didn't, investment banking, and they told us to go to the beach all day. But what would have happened if I was trading futures that day, or something similar to that? And you always got to think about sort of like that catastrophic event. I always worry about that, and so you have to input that into the model such that your risk of ruin is low. It's like, even if that one security, your thesis, something fraudulent, something totally was off, that you're not blowing such a big hole in your balance sheet that you can't recover. And I've seen all sorts of different things in my career, but we try to estimate what the downside upside is of this security, this investment, and we plug it in and say, well, let's make this the position size. But there is some instinctual overlay, some theory, and you just have to stay disciplined and not stray from what works best, or bet the farm, etc.
I'm curious to hear more about it. So you, like you mentioned, you've done quite a bit of investing, including the SPAC with Del Taco. Tell me a little bit more about that story and what it was like to be on the other side, right? Because as a public investor, you're the one analyzing these companies, but that was a time when you were the public company and you got to see things from their perspective. What was that like? And has that changed how you now look at companies, knowing that you've been in one before?
Yeah, it was super, really, really interesting, really insightful. Learned a ton. What's been interesting is just in the 23 years, 24 years I've been in business, in the public markets, there's just been a huge increase in passive investing. The ETFs were a tiny fraction of what they are today. Now they make up many tens of percent. I don't know exactly what they make up, but they're significant. And it's the research has borne out that your average fund that actively manages is hard to beat the market, net of fees, taxes, et cetera. So everyone wants to invest in SPY, for example, which is all 500 companies, the S&P 500. That trend has just grown and grown, and I'll get to why that's significant in a second. To your question, Del Taco, at the time, it was a $500 million deal. I would say at the time that was a more legitimate public company than it would be today. Things have grown a lot. Sarbanes-Oxley costs and just regulatory costs have made it that basically any public company has to spend $5+ million a year just to be public in costs that they wouldn't have to incur if they were a private company. And on the flip side, as a small company, you don't always get what the textbooks would say, which is the premium value, the kind of highest and best place to be is the public markets. I think that's true for the Mag 7, a lot of large cap companies, Walmart, et cetera, all the companies we read about all the time. And I would say sub $1 billion today, maybe $2 billion, you're in this sort of purgatory, and the smaller the market cap, the more the purgatory. And so if you're not in an index, going back to my first comment, in the case of the small cap world, that is the S&P 600 and the Russell 2000, then you're not investable for a lot of companies. If you're a small cap already, you're not investable for a bunch of the large funds. And there's a lot less funds out there. The ones that are left are much larger. We can operate in sort of a nichier space, but there's just not a lot of people looking at these small companies anymore. And so like Del Taco, sure, I think at one point Fidelity was an investor, but over time it gets harder for Fidelity and the big firms to invest in small companies. They have $1 trillion put to work, whatever the number is. And so it's riskier to invest in smaller companies. I get to see from that side of the table that a lot of the big funds couldn't invest in us. So it didn't matter whatever the outreach was, or if our management team was at conferences pitching it, is all these niche small guys. There's less and less of us investing in these kind of companies now. And so for much of our history, because of this, we were discounted from our private market value. And as a result, we got inbounds plenty from private equity firms that wanted to take us private. So we had discussions with strategics because we were spending $5+ million a year to be public. And our EBITDA was 60 to 70 almost all the time. It was we grew it some, but it was hard with minimum wage in mostly California stores. We'd have a hero product, and we created the Del Taco when we were there, which was like effectively the Big Mac of Del Taco. And that drove a lot of sales, but it's hard in California to get a lot of that to flow to the bottom line. So it was like and it was, other than right out of the gates when I think a bunch of New York hedge funds thought we were like Chipotle and had never been to a store and priced in a lot of growth. This is a brand that is a great brand. A lot of cult following in California, Southern California in particular, but hard to grow a regional brand outside of California. Some hits and misses as you go to Florida or different markets where there's less brand recognition. And so we were a public company as Del Taco for 7 years, but we could never quite get to the major index level, the large cap stocks, the growth story. We were kind of stuck in this value land where we were discounted. We also, having been born out of a SPAC, we're kind of in the penalty box just for the fact that SPAC was a 4-letter word to a lot of people. I think it still is, maybe even more so. And so we had a warrant overhang, which we eventually got rid of, and that penalized us. So we traded at a discount, and we'd had inbounds quite regularly. It didn't matter almost what we did. Times were a little bit higher, a little bit lower. Most of the time, we were at a discount to private market value. And just while I said 60 to 70 EBITDA, our free cash flow, it's a capital intensive business, was a fraction of that. And you take out, so let's say our free cash flow on average was 20 million. Well, 5 million plus of public company costs, that's a significant amount of our free cash flow. And that's something that was an arbitrage of sorts for another buyer to own. And so eventually, after years of these inbounds, we ran a process, and some of those same private equity firms that inquired showed up 30 to 50% premiums to where our stock price is trading. That's what a private LBO model would suggest. We were trading for 7. They were coming in, like $10 a share plus or minus. But strategics can pay more because they have synergies and redundancies that they can cut, and they don't need, uh, there's purchasing power, et cetera. And so Jack in the Box and one other strategic bid higher. And so we took them through the process, and ultimately Jack in the Box took us out at $12.51 a share. We were trading at 7 at the time. So it was a meaningful premium. We looked at each other as a board and said, this is the highest and best value for our shareholders. And so try to learned a lot that we believe, companies sub $1 billion, again, you can make a case sub $2 billion, really ought not to be public. Unless there's a great growth story where they're going to get out of that, they have a chance to get in the S&P 500, which typically comes with I think an $18 billion minimum. You're in this sort of purgatory of small funds, and you're very much beholden to the indices if you're in them. When you get kicked out of the indices, there's tons of forced selling because all of a sudden the BlackRocks and Vanguards of the world can't own it. That's actually created some interesting opportunities for us, where we've had at Lakeview, we've run 4 activist campaigns of sorts. We've had people on the boards of 3 public companies, and 2 of them have been sold. So we believe that the cost benefit of being a small public company often doesn't make sense. And once you're kicked out of the indices, you're really left for dead, and you're in purgatory. You got to grow many multiples. And right now, the cutoff point for the S&P 600 is 550 million, and for the Russell 2000, there's no hard cutoff. But if you're sub 100 million, you're really in danger zone of being completely left for dead.
How I'm curious how you think about that growth, especially in maybe like in the restaurant space. I mean, you've seen companies like Kava or even Dutch Brothers, where the idea is to take a regional brand and scale it nationally. But to your point, it's not always trivial to do that. And some of the Wall Street folks can get that wrong, assuming it's going to happen. So what do you think makes a regional brand scalable nationally that can then warrant that kind of explosive growth?
It's gotta fit in with the trends. So Kava, they've become the Mediterranean chain. Obviously, it's got food that people think is delicious, and um, it comes into their statistics. If you dominate Southern California, that's great, but then you struggle when you open in other markets as you go east. The market's going to start to discount for the fact that you can't assume that these 600 restaurants are going to turn to 6,000 restaurants. But if you do well in most places you go, or everywhere you go, the market's going to extrapolate. If you get a 30% cash on cash return on average in your restaurants, and now the market, and you've done it in other regions, now the market can extrapolate that you can do in other regions. Maybe you can do it internationally. Obviously, you got to have a good offering for people right now. In fast food in particular, the trends have been incredibly difficult. You've got major inflation, you've got labor inflation, you've got food inflation, construction cost inflation. So you just think about, ultimately everything's about ROIC, right? So if I build this restaurant and it costs me $1 million and it does $1.5 million in sales and has a 20% margin, well, that's $300,000. So 300,000 divided by a million is a 30% return. That could work, but often there's a bunch of other costs, and that 300,000 isn't really 300,000. There's a bunch of G&A on top. But if you or I or anyone could get a very low risk 30% return, you'd love to play that game all day long, whether you're levered or not. The restaurant space is just fickle. It's hard. And by the way, on the demand side, you've got the GLP ones, which are much more accessible now. And so the inflation has made it such that you can't really leave a drive-through without spending a lot more money than you used to. I don't know what it is at McDonald's to go through the drive-through and get a meal deal now, but it's well over $10, I believe. And just that value proposition versus cooking at home or going to fast casual like Chipotle or casual dining or more is not as compelling as it once was. So you got to really think about that kind of factor as well. Plus all the just qualitative, like in fast food, you've got 11 or 12 limited time offers per year. Are you hitting those promotions right? Are you capturing what people want, whether it be healthy or value or indulgent? And it's a tough industry. It's very capital intensive. It's at the whim of people's dietary interests. And we sold the company to Jack in the Box. A lot of it out of their control, just with these trends. They are now selling Del Taco for, and the rumor is it's going to be way less than what we sold it to them for. And Jack in the Box itself just had -7% sales, and it's hard to compete. McDonald's is always the sort of leader if it's a value environment because the consumer is cash strapped, and I think that the middle low end consumer is particularly tough right now. They care about the value. What is McDonald's doing? If McDonald's wants to lower their prices so much that they can make it such that all the people are going to go there, or most of the people, that's tough for Del Taco. That's tough for everyone else. I would put Taco Bell in its own category. I think it's by far the best of all of them in terms of the consumer experience. And that always impacted Del Taco as well. There's Taco Bell, but it's a difficult business, and if your returns instead of being 30% are zero because some are 30 and some are -30 because you missed in whatever market, you know, the market's not going to like that, so you're not going to get a growth multiple.
I'm curious if we let's talk a little bit about the Wiener Circle, right? Because it's obviously a restaurant, and to your point, it's much more of an experience. And yeah, for those who don't know, it's definitely worth a Google or search on YouTube for it. There's some phenomenal videos. I think there was one with like Triumph, the insult dog on there, like making fun of all these customers that are trying to buy hot dogs. I'm curious, like, if you think a concept like that can scale. I'm sure you've thought a lot about this, but it's not so much about the food, although the food, can be great, but it's more so about the experience. And if you want to go out and it's one thing to go out for an experience in a fine dining restaurant, but this is completely different. You're getting a comedy show on top of your meal. Do you think people would go for that on a broader national scale?
I'm not sure. It may be. I think it's definitely in the right. I think in terms of trends, people want experiences. Coming out of COVID, certainly that people want to still want experiences, and people's ADD brains these days want like that fun experience, quick eating. I think the food's particularly good, but it's known more for the comedy. People want to laugh, so experiential stuff. You see the Savannah Bananas in baseball, like it's professional baseball, but sometimes it doesn't look like baseball, and it's wacky and it's entertaining. And they took a traditional game and made it fun. It's not to compete with the major leagues, but they just sold out Guaranteed Rate Field in Chicago. I think the Wiener Circle is just this fun, irreverent, experiential place where you never know what you're going to get. By the way, if people watch that video, don't do it around your kids or work. Staff can be a little bit vulgar, or more than a little bit, but it's all in good fun. By the way, it's like a roast on the way in, but a figurative kiss or hug on the way out. And they know who wants to hear it and who doesn't, and who can tell who's got thicker skin and who doesn't. But creating that experience and laughter for people is a lot of what people want. It's a lot of why, if you want to go to a hot dog stand in Chicago, there's tons of options. But with the Wiener Circle, you're going to have an experience with it as well. Our pricing is a little bit higher as a result, and our staff gets paid more. They're, some of them, professional comedians. Poochie, who's very prominently featured in that Triumph video, and a commercial we made during COVID that people should Google, called, if you just Google Wiener Circle, we're here for you, you'll see it. Also pretty vulgar, but we really tapped into this COVID culture where everyone was locked down, and we made people laugh a lot. We did a sort of a fake, FaceTime phone number where you could order for pickup. And, whether it's replicable, I think it is in some way someday, but it's also kind of a one of a kind thing. And it's, it has its pluses and minuses. It pays in laughter, but it's a tough world out there. It's hard for people to get by working at a hot dog stand. So we pay people more, and try to take care of them. And it's just a tough world. So I hope there was a licensee when we bought it in Los Angeles that was going to open one. I basically talked them out of it because They were deep movie background people, but it was, I didn't know if it was going to work in LA without professional restaurant management, and wanted to control it. But we may license it again someday or open more. But it's not my main focus. I just want to have the most fun with that particular store. By the way, we just filmed a pilot of a TV show that we used our profits from the year, some of our profit to finance, and that was super fun. Just a couple weeks ago, we filmed at the store a sketch comedy show with some really funny talent from Second City, which is the improv feeder to SNL, and Chicago is a huge improv community. So it was kind of a sketch comedy blend between our staff and a bunch of Second City folks, and a guy by the name of Dion Cole, who's the Old Spice guy. He's a Chicago guy, great guy, hilarious. He's got a bunch of Netflix specials. He's on Blackish and Average Show. So he was the host, and we're hoping to try to sell that to a streamer, whether it be Netflix or Hulu or whatever. It's fun to have the creative project.
Yeah, I was actually going to ask about that side of it. 'Cause it sounds like these days for any brand to be successful, there's got to be a media component to it. And you guys are, it seems like you're ripe for content creation. I know you do have a couple of videos that have gone viral on TikTok. I think the biggest one I saw was something like 11 million views. So yeah, how do you think about that side of advertising? But it's more so, yeah, content creation, media, and not just necessarily for the Wiener Circle, but more broadly across some of the companies that you're investing in.
I mean, I love the content creation. I think it's such an important part for a consumer brand. Wiener Circle has license to say and do things that other people don't. That's one of the reasons we bought it. It's just to say whatever we want on the sign, to make fun of everyone. A lot of people have thought we were like the liberal voice because we made fun of Trump a lot in the early days, but we've made fun of both sides of the aisle. Tend to be more in the middle. When Elizabeth Warren, when there was all that story about her, whether she was Native American or not, we had a sign that said Elizabeth Warren is 1/8 Polish sausage, and then people like that. And so we've for equal opportunity roasters. The content is important. People like the irreverence. We pissed a lot of people off. Sure, people say I'm never going there again. Somehow our sales have actually been up quite a bit, and just a fun experiential place that people of all different backgrounds want to go. You see people in lawyers in suits and construction workers and kids' birthday parties by day, and it's just a community that's fun. I hope it's replicable someday, but it's just a fun. Like I said, it pays in laughter.
Yeah. Well, yeah, it's gonna be fun to have that kind of a restaurant available to. Um, but to shift gears a little bit, I'm curious if you can talk more about Green Thumb. It sounds like that's one of your like a very successful trade. You mentioned it was 80x on your money. How that space has not been that successful for others. There have been plenty of companies that have failed in it. How, yeah, what do you think was the secret there, and how do you view the broader industry?
So yeah, there's been a boom and bust of sorts in that industry. I think at one point there was a bubble. Valuations got too high. But even before that, you heard on the private company side, a lot of folks that lost all their money. It's obviously a risky space. We wanted to get in from the ground, win the licenses, spend the legal and lobbying dollars to secure the licenses, do it the right way, get the right security plan, safety, etc. It was a great call option on something that would do really well. And while there's been talked to a lot of people that haven't done well or have invested in this company or that company, there's not always the highest quality people in that space. So just by bringing a little more business acumen, and I give Ben Kovler, our CEO, a ton of credit, just bringing a level of sophistication that some of the other folks in the industry didn't bring. People thought overspent on marketing, and Ben's been frugal and disciplined and built a really good brand, spent a lot of marketing. He does a lot of music festivals and ties it into culture and lifestyle. But we were, I guess, an anomaly of sorts, just in that not everyone has done very well in the space, and obviously subject to a lot of regulatory risk, but it's been worth it.
What kinds of companies do you are looking to invest in now, or some of the themes that you like?
So we're bottoms up. It's not like we take a theme and then we want to go find the companies in that, although I've done that before. But we are looking for, in terms of long investing, companies that have some sort of competitive advantage, hopefully a major competitive advantage, but often are too small to be public. Sometimes they've gotten kicked out of this index or that index or all indices. And so it depends. We see our sweet spot has been industrials. So, much easier to sleep at night with companies that sort of make the world turn, and from just a industrial standpoint. So, we were investors in a company that makes over half of the tow trucks in the US. And there's tow trucks are here to stay. It's not the sexiest growth business, but it's going to grow at GDP plus, or GDP at least. And we found the best player in the space. Recently, we filed a D on a company called Commercial Vehicle Group, which makes about 40% of the seats for Class 8 trucks and similar type vehicles. Not a sexy business. They make wipers, blades, and wiper systems and wire harness systems for those products, but it's not a sexy space. It's particularly down right now because they got kicked out of all the indices, and truck manufacturing is down a staggering amount this year. It's down 24%. Under the Biden administration, there was an emission standard where trucks were about to get a lot more expensive in 27, but it looks like that's going to be repealed. So it's when's the growth going to come back? But basic industry, basic materials, industrials are some of my favorites. We do some consumer stuff as well. Typically don't do biotech or super complicated technology. The simplest stuff is the best, and that tends to be industrials a lot. There was one activist campaign I can talk about now. It was a really small company called Tesco Technologies that is a distributor of wireless telecom equipment, mostly big equipment that in their case, we invested right before 5G started. So we saw at least the growth there, and we bought up just under 15% of the company. We actually tried to buy the company out ourselves, but in stock was trading for 5. We bid 750, big premium. They told us no. That was privately. Then we went public with our offer, and ultimately, we got a couple board seats, and not myself. We had people serve on the board for us, and ultimately, they realized the cost benefit of being public didn't make sense, but it wasn't without some ups and downs, and ultimately, a strategic that was owned by a private equity firm, so really a private equity firm with some synergies, bought it at $9 a share. And that was just a basic distributor of telecom equipment. So, easier to understand businesses. Love to find a consumer one. We're working on some now, but none that I can speak to yet.
When you think about these, whether it's the truck company or wireless equipment, maybe talk a little bit more about your process. I mean, you mentioned there's easier to understand, but I'm sure, is still a lot of industry knowledge about how those different companies operate. Like, what's your process like? How do you get up to speed on it?
So you start with obviously the financials. They have their company presentation. You get to talk to the company, but before that, you read the K's and Q's, the investor conference calls if they have them. Some of these small companies don't, and they just would rather shareholders not know that much about what's going on. And you start with and then we do a full write up. We get into all the details of customers, suppliers, competitive advantages, who are the other shareholders, who's the management, you you name it, and you could go on as much as you can go as detailed as you want. And ultimately, we try to come up with some sort of downside upside. It's like, okay, this company is trading at net asset value, meaning we think we have a really good margin of safety. Even if they go from making money to breaking even, the book value is going to be a good downside protection metric for the stock for the reasons I mentioned before. But in addition, through a cycle, they should make a 20% return on capital and unlevered, or whatever it is, 50 something decent, and generate a lot of free cash flow. So uh, in the case of these companies, we're looking for the best quality free cash flow that we can, and then that's the upside. Ultimately, a security is worth the sum of its future discounted cash flows. And we're trying our best to estimate what is the competitive position? Can they do they have pricing power, et cetera? And so just think about a downside, upside, and plug it into the model and go from there. Then from there, if there's an activist case, there's a whole governance strategy. What are we ultimately trying to accomplish? It's not always this company needs to sell. Sometimes it's they could break this company into two and be worth more, or divest this business and just keep the good business here. So we do actually trade a lot of spinoffs when those occur, similar to the index inclusion or exclusion. Sometimes there's a lot of forced selling. So one of my favorite investments was Madison Square Garden, a company we all know, owns the Knicks, the Rangers, the Garden itself, some other smaller assets like the Rockettes show and the Chicago Theater in Chicago. When they were spun off of Cablevision in, I believe, 2010, Cablevision shareholders, which were large cap shareholders that wanted to own it as a cable company, were forced sellers. They couldn't own this. It was literally trading for a billion market cap, maybe even less. And so for $1 billion, you got the Knicks, the Rangers, the Garden itself, and you think about what those are worth today. But even then, those were worth way more if you looked at the Forbes values. So great assets, trophy assets, not necessarily huge cash flow assets, but very much trophy assets that many billionaires would want to buy if the Dolans ever chose to sell it. You put a discount for the Dolans owning it, but still, and you had forced selling. So great. Some of our best ideas are when a company we really like has forced sellers. Give us that stock. We'd love to buy that from you. And so we're kind of trying to marry the fundamental with the technical.
And so when situations like this, like you're mostly or you're almost exclusively on the public side, but you do. It sounds like on some occasions have taken a bunch of these companies private. Do you have relationships with some of the PE firms? Like, is this part of the strategy, the take private of some of the smaller caps that you don't think need to be public anymore? Going back to the point of about how much it costs to do that. Like, I guess yeah, talk to me about that side of it, like the sort of the relationship side. Like, is it important to have that as a part of the strategy, or do you just kind of figure it out on a case by case basis?
That's a really good question. It's a really important point, actually. So first off, we've bid for companies that are public, but we haven't bought them. We've bid typically private equity like prices, but we own stock. If a strategic or someone wants their model says it's worth more, or to them it's worth more, ultimately that's what the company should do, is sell. That's highest and best value, of course, is to sell to someone else. So like I gave that one example where we bid and someone else paid more. But to your question, yeah, networking with a lot of private equity firms is extremely important, because what I would say is, they trade private asset to private asset. But I would say if all the small public companies were on the market today, or a bunch of them were, they would drop everything and look at them. A lot of it within their charter, they can't take positions in public companies. They certainly, if they can, they don't want to be activists or hostile. And by the way, we always approach companies on a friendly basis. We're not trying to be hostile. We're not hostile people. But ultimately, if companies are not doing right by shareholders or something, there's glaring, blatant bad stuff going on, we will bring that to light, PR, whatever. But to share notes with a private equity firm that says, hey, we own a company that makes this kind of widget, and we think this public company that makes a similar kind of widget, we'd love to, if they were for sale, they look really cheap. You might want to look at them. Those are important metrics we try to learn from anyone we can talk to, and a lot of the private equity guys have tons of industry knowledge in certain sectors. They're close to the financing market, which we're not always so tuned into. What's the LBO market right now to take this company private? And so we network heavily with private equity and with investment bankers, and try to arrange financing, see what the financing market looks like to try to buy company X or Y. And will private equity think it's interesting as well?
Well, what do you think is the firm has evolved a couple of times over the 20-year history that you guys have been in business? What do you think is next? Are you thinking about other business model changes, or how do you think about the future?
I'm really excited to do more of this arbitrage stuff again, and to find different versions of the same security to spread against each other, and use smart algorithms and programmers and a great team that I have to unlock that value. Like I said before, I think the only thing that's certain right now is volatility. That, by the way, makes me really like CBOE stock. I have for a long time, I've owned it for a long time. They have basically a monopoly on VIX, and their stock has compounded let's say like 15% over the last 15 years or something like that. Also uncorrelated. So its beta is actually less than zero because when markets go haywire, go down, have a lot of volatility, their volumes go up. So it's counter cyclical. So, we'll always continue to buy and sell stocks, but I'm particularly excited about some of our arbitrage things. And then there's always new activist campaigns that come up that are interesting. I love learning about this industrial company or that consumer company and saying it, typically not restaurants, but it was a restaurant. What's the, or anything, what's the ROIC on the unit economics? And can we open a bunch in other markets? And what multiple does it trade for? And what's the free cash flow yield? I'm excited for all of it. I'm excited for the Wiener Circle. I'm excited for what Ben does with the cannabis business and all of it. I love my job and interested in all of it.
Or yeah, this was awesome. It sounds like you've done quite a lot in the 20 years that you've been running your business, and it's been a pleasure having you on the podcast. Thank you so much for joining me.
Thank you for having me. Definitely stay in touch and we'll talk more soon, hopefully.
Sounds good.